The webinar will begin in 2 minutes. The webinar will begin in 1 minute. Welcome everyone. Thanks for joining us for today's webinar covering year-end strategies for 2020. The webinar will last approximately 15 minutes, and at the end, we will tell you how you may request supporting materials by email. We'll also tell you how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Lineberg, and Linus regularly speaks at industry events. His latest book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, which was written together with a CPA and a business broker, is now available for sale. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. And here he is.
Thanks, Jennifer, and welcome everyone. We're glad you're with us. We're hopeful that you'll get some information out of today's seminar or webinar that will be helpful as you plan your meetings with clients here for year end and going into next year. Before we get into today's content, let's decide on what we're going to talk about next month. We have these webinars the first Wednesday of every month at 11 a.m. Central, and next month's will be on January 6th. And so I'd invite you to mark your calendars for that. But what I'd like to do now is I'd like to ask you to vote on one of the three choices listed here, RMD management in 2020 and 2021 and beyond. HSAs in a nutshell, that's the second choice. And then the third choice is ethical issues with incapacitated clients. Let's go ahead, open up the poll and give you the opportunity to vote for one of the three that we'll talk about. Please go ahead and vote. Give you another few seconds if you haven't yet cast your vote. No fraud in this election. All right, let's go ahead and close the poll. We will talk about RMD management in 2021 and beyond next month. Thank you for participating in that and appreciate that very much. So let's go ahead and talk about what we're going to talk about today, which is year-end planning techniques. And look, a lot of times, I don't know if you're like my CPA, you'll get a generic letter from your CPA or other tax professional saying, you know, there are certain year-end things that you ought to be thinking about doing. And it seems like that the letter is just the same every year, that they simply put a new date on it, and it's the same stuff every year. And I'm not saying that the ideas aren't valid, but they tend to be kind of overused and kind of tired, as is represented by this tired picture here in the slide. I mean, it's accelerate or defer income, accelerate or defer expenses, maximize qualified plan contributions. The acceleration of income or expenses pours stuff into one year or the other, so that one year or the other has low income and low brackets. And sometimes you can save money by making those kinds of plans, particularly if you're a business owner. And so there's nothing, as I said, there's nothing wrong with those ideas, but they kind of tend to be overused. So what we wanted to focus on for today's webinar are things that that CPAs or other folks aren't necessarily talking about, some things that are potentially unique to 2020. One idea that people don't talk about much is Social Security wage arbitrage. It's not unique to 2020, but it is an idea that that does have some legs. Talk about low income Roth conversion, taking advantage of the fact that our clients might be in a low income tax bracket in a given year to convert some of their traditional IRA money to Roth IRA. Similar idea is low income capital gain harvesting. If we've got a year with low income, makes sense to recognize capital gains to take advantage of perhaps 0% capital gains rate. Something that is unique to 2020 is for those of our business owner clients who've gotten PPP loans as a result of the CARES Act, to prepare to apply for loan forgiveness if they aren't already in that process. It's an important thing to remind them of. There's some opportunities for our clients to either create or use their C corporations to help with their tax management, particularly at year end. There's also some opportunity for our clients to plan for charitable gifts, to make gifts to family members if they're in a situation where they're worried about estate taxes. And then another thing that's particularly 2020 related is COVID related distributions. If somebody's eligible to take a COVID related distribution, the end of the year is the deadline for doing that and taking advantage of some pretty special tax advantages. So we're not going to talk about all these things in detail, but we are going to talk about some of them in a little bit of depth in the 15 or 20 minutes that we're together. So let's start with the Social Security wage arbitrage deal, and this is really for business owner clients. The situation is the Social Security Administration collects 6.2% premium from employees for their wages, and it's the first 137,700 bucks of wages in 2020. If you're over that, they only collect an additional 1.45% against wages on the amount in excess of that. All 137.7 at the bottom also gets the 1.45% premium, but everything above that also gets the lower 1.45% premium. These taxes together are sometimes referred to as FICA taxes. And not only does the employee pay FICA taxes, our business owner clients also know that the employer pays a matching amount to the Social Security Administration in terms of FICA taxes. And so because of the fact that the higher 6.2% premium is collected only on in 2020, the first $137,700 of wages, that kind of gives you the idea of what the opportunity might be. And so if we've got somebody who makes 150 grand in 2020 and expects to make the same 150 grand in 2021 from his business, and if he's going to get going to pay FICA on both of them, the 2-year FICA total would be 43,481. The FICA base goes up from 137.7 in 2020 to 142.8 in 2021, and so the FICA for 2021, the 6.2% portion is $22,057. So it's a little higher in 2021 than in 2020. But the bottom line is the 2-year FICA total, including both the employer and the employee portions, is over $43,000. Well, what if we paid the owner of the company a little bit differently? What if instead of 150 grand in each year, we paid 250 grand to the owner of the company in 2020 and only $50,000 of salary in 2021, right? If there was enough money in the business to be able to make that work. So our client would still get 300 grand in total wages, but the FICA calculation would change. And the bottom line is that the client would save a significant amount of money by employing the strategy. And the amount of money the client would save is over $7,500. Or no, excuse me, more than $11,000 over the 2-year period. That's the bottom line. The slides have the calculations. You can kind of look those over, but $11,000 is real money. And so it's something that our highly compensated clients, particularly those who have C corporations, it's something that they ought to think about in terms of the timing of their payroll. And certainly the client CPA should be part of the process in thinking about it, but it is something that ought to be thought about and something that could potentially be planned for with regard to our clients. It's certainly something for our business owner clients. It's something that we could take to them and ask them if they've evaluated whether Social Security wage arbitrage is something that they've thought about or something that their CPA has talked to them about. The answer is almost certainly no. And so it's an opportunity to talk to your clients about something that isn't directly related to sales. So let's shift and let's talk about potential low income Roth conversion. So our clients, have, a lot of them have pre-tax IRAs, pre-tax qualified plans, and they'll have to deal with RMDs in 2021 and after from those accounts. And when they take minimum distributions, they'll have to pay income tax on whatever is distributed, minimum distribution or anything in excess of that. If instead the money is in a Roth IRA, and the Roth IRA has been aged for 5 years and they're older than age 59 and a half, everything that comes out of a Roth IRA is income tax free. And so all things being equal, Roth IRA money is more favorable for a retiree to have than traditional IRA money. Well, if converting traditional IRA requires somebody to pay taxes now, that's not necessarily a great thing, except that if someone's in a low income tax bracket right now, doing Roth conversions to take advantage of the low income tax bracket so that they can have tax-free income later on when they might be in a higher bracket is a good thing. And I'm not going to go through the example here, but if we've got somebody who's in a low tax bracket, maybe because they've been laid off, or maybe they're taking a break from work, or maybe they expect to have a windfall of taxable income later on, they ought to think about converting money to a Roth IRA while they're in low federal income tax brackets, so that they can rely on getting tax-free income later on. And for many of our clients who are worried perhaps even unreasonably worried about the coming increase in federal income tax brackets, the predicted increase in federal income tax brackets with the new Congress and the new administration coming in. You know, even those folks who aren't in the lowest brackets might think about doing Roth conversions this year for planning to try to avoid higher tax rates later on their IRA distributions. So that ought to be thought about. What else ought to be thought about? Well, charitable gift planning. We're at the end of the year. We ought to work with our clients who are charitably inclined to make gifts to charity. One of the rule changes that was made for 2020 is that if you write a check to charity, you have the potential to deduct the cash gift, and cash gifts can be as high as all of your adjusted gross income. The problem with making a cash gift is that while a charitable deduction is tax deductible, for most people, in order to take a full advantage of the charitable deduction, they've got to itemize their expenses. And with the increase in the standard deduction, not everybody itemizes anymore. So it makes sense to think about making charitable gifts that don't rely on the itemized charitable deduction to get some tax advantage. And so if you've got somebody who's older than 70 and a half who has IRA money, they ought to consider making a gift this year directly from their IRA to a qualified charity. If you're older than 70 and a half, you got an IRA balance, you can give up to 100 grand a year directly from your IRA. The money's sent to the qualified charity and the money doesn't hit your income tax at all. And so it's a very efficient way for somebody to make a charitable gift. Even though RMDs have been waived for this year, the qualified charitable distribution technique is still available. Taxpayers can give up to 100 grand a year, a very efficient way to make a gift this year for somebody who is charitably inclined. What else is timely? Well, for those of our clients who are very wealthy, who are worried about estate taxes, I think they are rightly concerned about the potential for a Democratic presidential administration, as well as the potential Democratic Congress, to increase the estate taxes either by decreasing the federal estate tax exemption from its current $11.58 million per person level to something much lower, or perhaps increasing the amount of estate taxes. And what's a way that a person can make a bet on the estate tax rates or the exemption amount, the estate tax rates going up or exemption amount going down in the future? Well, they might make a gift now before the end of the year, might make a sizable gift using up part of their $11.58 million federal estate and gift tax exemption. There's been some history from the IRS in the past where the service has said they're not going to try to retroactively impose gift or estate taxes on gifts that were made in reliance on the then current gift or estate tax exemption. So for clients who are very wealthy, sizable 2020 gifts should be considered. And because we're already at the 2nd of December, time is running out. So definitely we need to visit with our clients who are in that category prior to the end of the year to make sure that they're thinking about that kind of thing. And then one final thing that is timely is the COVID-related distributions. So the CARES Act created this special category of COVID-related distributions. If someone's been affected by COVID, then they've got the opportunity to take a distribution of up to 100 grand from their IRA. They may also have the ability to reach into a current employer plan and take out 100 grand if the plan allows for it. What's the advantage of taking a COVID-related distribution if they've been affected by COVID-19? The answer is that the one direct immediate effect is that the distribution is exempt from the 10% penalty tax. And also, if it's a COVID-related distribution and it's taken before the end of the year, the distribution doesn't have to be included in income all in 2020. It's included in income over 2020, 2021, and 2022. So there's that. And then also, if the client changes her mind within the 3 years after taking the distribution, the client can decide to roll over the distribution into an IRA or into another qualified plan, essentially using the 60-day rollover technique, but taking 3 years to do it. And so it's a tremendous opportunity. If you've got a client that's been affected by COVID and the client needs some money, it makes sense to think about having the client take this distribution and use it based on the COVID-19 rules. Other reasons for a client who's been affected by COVID-19 to take the money, even if they don't need it, is, first of all, it turns normally inaccessible employers' plan money into an IRA through the rollover process. It is the functional equivalent, or it can be the functional equivalent of a 3-year interest-free loan by taking the money out and then paying it back at the end of the 3 years. And it allows a client to pursue a Roth conversion by taking the distribution under favorable income tax terms, allows the client potentially to put off the day of reckoning on a Roth conversion. So for our clients, all of our clients, if we need a reason to go visit them before the end of the year, we can certainly talk to them about whether they've been affected by COVID-19 and whether they should be candidates for taking qualified plan distributions this year. So what else ought to be thought about in terms of stuff that clients ought to be thinking about, not only at the end of 2020, but at the beginning of 2021? You've heard us talk about these things before. Review and update beneficiary designations for all of our clients. A lot of our clients have those wrong. Let's make sure they've got them right, because beneficiary designations control a lot of liquid wealth at death. For our business owner clients, make sure that they've got good current business continuation plans. For all of our clients, we ought to strategize with them for 2021 about capital gains transactions, charitable gifts, family gifts, and potential income tax losses or windfalls that might occur in 2021, so that we can plan for those in advance rather than react to them after the fact. And then, if we're visiting with our clients, we've got to ask them about what's changed for them in 2020 and make the proper alterations to their financial and estate plans. These are all reasons for us to go visit with our clients and to help serve them better. So a lot of times in December, we're doing paperwork. Our business for the year is wrapped up, but it's an opportunity. It's an opportunity to jumpstart business, jumpstart opportunities for the coming year. A few of these strategies that we talked about today are time sensitive. They are 2020 year-end unique, and so that they ought to be talked about with our clients. But you've got an opportunity to talk not only about those things that are current for 2020, but other things. You should make it a point to visit with your best clients, your best prospects, to discuss these planning ideas so that you can serve your clients better. And at this point, I'll turn the program back over to Jennifer. Jennifer?
Thanks, Linus, and thanks for joining us today. And as a reminder, if you would like to receive supporting materials, feel welcome to email me at asktheexpert@advancedunderwriting.com. Again, that is asktheexpert@advancedunderwriting.com. Don't forget to join us next month on January 6th for RMD management in 2021 and beyond. If you would like to email questions related to today's webinar, send them to asktheexpert@advancedunderwriting.com. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. You can review this webinar and our previous webinars on our YouTube channel. You can find us at Advanced Underwriting Consultants on YouTube. Please subscribe so that you can get notifications for new webinars and new postings. Thanks again for joining us today, and best wishes for continued success.